Hello everyone, welcome to Officer 24/7. My name is Niharika Valia Bhatnagar and I am with you with the area of Advanced Business and Financial Management. First of all, everyone, before I continue with my session, please go ahead and like the particular session. It is very important that I get motivation from your side. If you like this session, then please go ahead and click on it. And along with that, click on the area of subscribe button as well. Subscribe to our channel so that you get all the updates regarding the particular examination. Right. So let's quickly move on and please share this session among your peers as well. Acha, as we already know, I am done with the entire module A. We did a few complete numerical sessions as well. Now I'll be taking up the next point, that is the module B. Module B is super important. Why is it super important? Because this particular module determines your base for as well as B. In the module we'll be covering a lot of topics which are again taken from module B. So I'll be telling you about a few chapters where I'm going to spend a little more time as compared to other chapters. That is, first is this chapter, and accordingly, there's one more chapter, the capital investment decision. These two chapters are something I would want that you should not skip at all. These are something which are inescapable. If you leave out on any of these chapters, then it would be troublesome for you only, because this is the base for the other chapters. Then please make sure that you are giving time to all these particular subjects in the best possible way. Not only with a half-hearted way in let's just do it. Give it to the best shot. Only then you'll be able to have a better situation there. Okay, now let's move on to the questions that we're going to deal with today. In terms of sources of finance, we're going to talk about multiple things now. So what am I going to talk about? I'm going to talk about the area of financing. I'll be talking about the area of the equity, shares, capital, then debt. All these important terminologies of finance will be studying about. First is, if I have to put money into the business, it has to be my money. That is, it is equity. If I'm not able to use my money, then I'll be taking up money from outsiders. Then what will we call it? We will call it debt. So first is, my money is called equity. Called equity, and money that we take from outsiders is called. So we have to be very sure about this entire situation, that what are we going to do? Are we using our own money, or our money has fallen short? So we'll be using the money of other people. Okay, now let's talk about the question, everyone. It says, what is the purpose of bridge financing in context of business financing? So what do you mean by bridge financing, everyone? Bridge financing is a situation where we talk about wants to take a flight. They just want to grow themselves to the maximum. They want to have the goal where they are having everything in their hand, right? Now that is what they call about equity and debt only. So then, if they are thinking we have got enough equity, we would like to go for debt. What is the particular thing they have to think about? First of all, you have to, what is the purpose of bridge financing? Under the term bridge financing, what they're going to do is they will have to make sure that before they get themselves the big loan, they might have to depend upon smaller loans, because if I would like to increase my project, I want to increase my large scale business, I want to reach to that high scale business process. And all of a sudden, I'm stuck in that area that at this point of time, I have limited money. So to get that high level position, I took a very big loan. But to get the loan, I have to wait for around a couple of months, maybe 2 months or 3 months down the line. So what do I do about these 2 3 months? Which is the mini work, the minute work, or the little work for that particular huge thing? I have to keep on doing it. I have to get that particular work done. So if I have to do the big thing, and I have to make sure that I'm doing the small things so that I reach to that point. Progress for the main project is has to be created from today only. So I have to start investing money from today itself. The position where you are living in the short term and trying to reach the long term, and this is the area where we call it the bridge. Under the bridge, what's happening, everyone? Let me show you here itself. Uh, this is my short term business going on, and this is a large scale which I want to build up. and for this I need greater debt. But the greater debt requires time. But what about this during time when I'm trying to build up the base for this? Then I have to take major debts. So the intermediate time, whatever loans you're taking, is called bridge financing. Intermediate time, not the big time or the small time. To fund working capital needs, to establish a business, to fill the time gap between fund requirement and actual fees, and to finance current assets. What is the purpose of bridge finance? Bridge finance is basically to fill the time gap between the fund requirement and the actual release of the funds. Because you have to go through the tough time where you want money and you haven't got money. So during this period, you will have to do something about it, right? Which norm defines how much promoters should contribute as equity and how much they should borrow from the long term? Creditworthiness norm, debt equity ratio, working capital norm, or bridge finance norm? What is it going to be, everyone? What is it that amount going to be? Which norm defines how much promoters should contribute as equity? The promoters is basically related to the people who are starting their business. And acha, now in this case, they are saying about how much of equity they should have and how much of debt they should borrow. You have to find that balance now. How much money I'm going to use mine and how much money I'm going to use from other people. To have this balance, what I should do is called debt equity ratio. It's called debt equity ratio. Why do we call it debt equity ratio? Because under debt equity ratio, we will have the debts defined, that is the loans that we're taking, and the equity, which is the money which we are using our own. So we have to find the balance where we have both. That is the debt equity ratio. What does the working capital finance cover in a business? Long-term capital needs, short-term borrowing, gap between current assets and current liabilities, bridge financing. Working capital is basically your current assets and your current liabilities. So technically it's going to be CA minus current assets minus current liabilities. So that's the point, gap between current assets and current liabilities. Actually, working capital, there are two types of working capital, everyone. One is gross and one is net. The gross can be defined as only current assets, while net is defined as net current assets. That is net, oh, I'm sorry, it is current assets minus current liabilities. The answer is this, net working capital. In the working capital gap, how is it financed by gap between short-term and long-term funds, gap between current liabilities and short-term funds, gap between current assets and current liabilities financed by bank, gap between equity and debt. How do we define the term working capital, everyone? Working capital gap. Uh, when we define the working capital gap, that is the shortage of the money that we can have. So in this case, it's actually the gap between the current assets and the current liabilities financed by the bank. This means in terms of working capital, if we have CA minus CL, if our CA are increasing, so how will I cater with this? How, if I have to pay a lot of loans on short-term basis, but the money is coming slowly, then what will I do? I will take loans. I will take loans from the bank. You know, that's the amount that we'll be covering in this area. Now comes the next point. What is considered as the costliest form of finance and why? working capital finance and high interest rates, long-term finance, high risks, short-term borrowing, high service costs, or clean finance, higher interest rates. What is considered as the costliest finance? Costliest is basically the one which the cost of capital is very high. Matlab, in terms of debt, I believe to the people from whom I have taken a loan, I'll be like, sir, I'm paying you interest and that is it. You cannot interfere in my life. You are getting your interest and you are getting your principal. So no opinion from your side is required to me. Be very upfront because I don't owe you anything other than the loan that I've taken. But what about the money that we're taking from equity? But in terms of the cost, it's actually the equity, not the debt. Because debts we can define that this is the line which you cannot cross. But in terms of equity, we cross the line. So in this case, working capital finance or high interest rates, long-term finance, this actually now in terms of the working, when the person is in a dead need of money, everyone, when will you exploit the person? When he is having a lot of um, money requirements or when he doesn't have much. When he doesn't have much now, you will be giving at a lower interest rate. When he's in dire need now, you will always charge more interest because you find an opportunity. Right. So in terms of the overall, if I'm looking only at the financer, that is short-term borrowing, high servicing cost. One of the facts you will find that in terms of call money or others now, you will the interest is generally higher. Also then is clean finance or interest high interest rates. So what is clean finance, everyone? Actually, clean finance is the finance where you are making money from your equity. Equity debt is definitely defined. Yacha, this money, that money, defined interest rates, XYZ, everything is written to them in detail. But the problem with the clean finances, they are the family. That's the corporate family, the shareholders who have put their money into the business. The more you earn, the more you have to pay because they'll be standing in front of you that hold on. If the company is making 1 CR, then we are getting 10% of it. If it is getting more, then you have to increase our dividend as well. And you will have to give us bonus shares. Where is the interim bonus? Where is this and where is that? They are the people who have invested their money. So they are always nagging the company. Plus, with that, you also lose voting power as well because these people are investing money, so they are after your life. I have all the voting rights as well. So technically, clean finance has high interest rates. And among the long term and short term, you'll always find long term has higher interest rates. Sorry, short term has higher interest rate. The cost is really high in terms of the short term ones because you are in dire need and emergency means more required. So here comes the next question. What does equity capital represent in accounting terms? The equity in terms of accounting, how do we define? Equity in terms of accounting is basically the money which the businessman is investing in the business, the amount invested for establishing a business, the amount remaining after selling all the assets, the profits earned over the period of time. Actually, in terms of equity, you have two things. We have two things. First is share capital, plus second thing is the reserves. And surplus. These are the two things that we need. So in this case, the correct answer is both A and C. Technically, now this reserves and surplus has surplus, which is the excess of profit that you have earned but not distributed, and reserves can have general and specific reserves. General reserves are something which is something plain, which is something that we just say, okay, this is general. I'm just saving for the future. And when you say, nahi, I am saving for the specific building only. I am saving money for the specific land only. That is what it becomes specific. So that's both A and the correct answer. That's based upon this technicality. In our books, they specify the profits earned over the period of time and which is still in the business. In our book, they call it internal accrual. Internal accrual. Okay. What term is used to describe the rate of interest a corporate pays for its borrowing, which depends on its balance sheet performance and credit rating? Coupon rate, nominal value, debenture rate, or rating rate. We're talking about the rate of interest now. It is called coupon rate. Nominal value is the book value. Debenture rate is basically something we just don't say anything like this. We just use the word coupon rate because if it is written 12% debenture, then your coupon is 12. Okay? So, acha, it wasn't visible clearly. Is it visible now? It is 12% debenture. Done. Next topic, coupon rate. Then what are the financial rights of an equity holder according to the improved information provided? The right to income, dividend only, the right to retaining surplus assets in case of liquidation, the right to income, dividend, right to retaining surplus in case of liquidation, or right to vote only. Now the point is related to the of equity shareholders. Actually, everyone, voting right is basically something which equity shareholders have. They get both the dividend as well as voting rights. They still have it. But when we talk about shareholders, they don't have any voting right. There are two types of shareholders: equity and preference. Equity shareholders have super value in terms of the risk that they are taking. They have to pay dividend, but in terms of preference, it doesn't happen. So the right to income and the right to retaining surplus assets in case of liquidation. This is what the equity shareholders, who are the true owners of the organization, have the right to. Clear, basically, nothing more, nothing less. What increases the liquidity of equity shares if the company is listed on the stock exchange? The value of equity shares, nominal value of equity, listing of stock exchange, retaining surplus. Liquidity in terms of the working, what increases the liquidity in equity shares? Liquidity can be increased by this thing really helps us because if you are going into the SEBI now, SEBI will always be helpful towards you. So that would be the answer in this case. Why? Because if you are listed on SEBI, the public can invest money in your company. Your share capital will automatically be higher than the private companies because general public can invest in your company, and when general public invests, one particular thing that they would be yelling at you to be provided to them is basically what they will be asking you, sir, give me money as dividend. If you don't give me the dividend, why am I putting money? You know? And everyone, on towards the next. Which what is the term used to describe the maximum amount of capital that a company is authorized to issue in an insolvency? Maximum amount of capital is basically the capital which you have been given the permission for from the Companies Act 2013, which is Registrar of Companies, that is ROC provides you, and that is something which you had chosen and written it in your form. Issued capital, paid up capital, authorized or nominal, or retained earnings. In this case, max amount is basically your authorized capital. That is authorized capital or nominal capital. The answer is this. Authorized capital, nominal capital, also called registered. And everyone got the idea? And last question for the day. Equity shares have an unlimited life, voting rights, and receive dividends. Limited life with no voting rights but receive dividends. Unlimited life, voting rights, and receive dividends. Unlimited life, voting rights, but no dividends. They have unlimited life. So this limited life is something which is not there. They have unlimited life. They have the voting rights as well, and they also receive dividends. So answer is A. Oh, good for you. The answer is A. Editing is not done yet, so just a moment. The answer is A, everyone. I hope this particular session was helpful. In this session, I've covered almost a good number of questions. The basic terminologies of all the aspects of accounting have been covered. But before we continue further, everyone, what are we dealing with? Let's open up our website. And let me show you where to go. Go on to our website, that is www.adda247.com. Go on to this area, go on to the area of JIB and CIB. Go on to the area of JIB, CIB, Mahapack, because currently the Mahapack is available at 80% discount. So if you're taking it for 12 months, click on the area of buy now. Use the code Y541 and apply it. You will get it for 11,023.95. That is 79% if you are using the code Y541. And if you are doing this through the app, then you will get a discount of another 1%. So this would be less than 11,000, right? So please go ahead and check it out on our website or on our app for further details, everyone. Till then, keep learning and keep growing. I'll be meeting you tomorrow with the next session where we'll be talking about the entire. I think we are going to continue with this particular sources of finance. Unit 7 is super duper important. So please do this particular unit very carefully. Thank you, everyone. Till then, please go ahead and keep on studying. Have a nice day and